All right, let's jump right into this highly requested explainer where we are putting Perella Weinberg Partners through the ultimate investment framework funnel. If you follow the M&A space at all, you know it has been a total wild ride lately. So today, acting as your expert investment analysts, we are taking PWP's data and completely stress testing it. We're going to use the legendary philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, and then we're going to cross-reference all of those qualitative insights with some hard discounted cash flow math. Is this a hidden gem or a dangerous value trap? Let's find out. Here is the game plan for today. We'll start with a quick snapshot of PWP, then view the company through the Buffett, Lynch, and Graham lenses before running the DCF valuation models. Then we'll wrap it all up with a final recommendation. Kicking things off with Section 1, let's get a solid snapshot of where Perella Weinberg Partners actually stands today. Perella Weinberg Partners, which trades over the ticker PWP, is an elite boutique investment banking advisory firm. It was founded by the legendary dealmaker Joseph Perella, and they focus on highly complex M&A, restructuring, and capital solutions. In the market, they sit right alongside heavy-hitting competitors like Lazard. But unlike Lazard's massive 175-year global footprint, PWP is a younger firm. They're really known for a more intimate boutique environment and incredibly deep expertise in healthcare, energy, and restructuring. Now, looking at the financials, what really stands out here is their absolutely pristine balance sheet. Even though their Q1 revenues took a severe 30% hit, dropping down to $149 million, PWP operates with literally zero debt. Not a penny. Plus, they are holding $78 million in cash. Their trailing 12-month revenue sits at right about $688 million, with a net income of around $19.6 million. So with the stock trading in that $16 range, they're clearly navigating a serious revenue squeeze, but they're doing it from a position of total foundational financial safety. Moving right along to Section 2, let's put on our Warren Buffett glasses and evaluate their economic moat and management quality. The absolute crucial point here is that PWP passes Buffett's moat and debt criteria with flying colors. I mean, think about it. A 30% revenue drop would completely crush a lesser firm. But PWP's brand equity is so elite that they advised on 2 out of the 12 massive $15 billion plus mega cap deals this past quarter. That is the definition of a serious economic moat. As for manageable debt, like we said, it's zero. And looking at management, CEO Andrew Bednar is actively returning capital to shareholders. He's paying a 7-cent quarterly dividend and buying back shares, effectively returning nearly $64 million to equity holders in just one quarter. Buffett loves to see that. However, we do hit a bit of a snag when we try to calculate Buffett's beloved owner earnings and return on equity. Because their Q1 revenues took that severe 30% hit, their current trailing net income is painfully low right now. So, to properly judge their intrinsic value the way Buffett would, we really have to assume normalized owner earnings across a full M&A cycle. We can't just punish them for a temporary trough. But, as we'll see in a minute, even if we use normalized earnings, clearing Buffett's strict requirement for a true margin of safety on the purchase price is going to be a really tough hurdle at current valuations. All right, next up in Section 3, let's see what the legendary growth expert Peter Lynch would make of this. Categorizing PWP in Lynch's framework, we are looking at a classic cyclical play. Advisory firms absolutely ride the macroeconomic roller coaster of deal-making sentiment. They are currently suffering a revenue squeeze, which is perfectly typical for the bottom of a cycle. But here is the metric that changes everything for Lynch. Management is reporting that their announced and pending deal backlog is actually at a 2-year high. That strongly suggests a massive rebound is brewing right beneath the surface. Furthermore, Lynch is famous for following the smart money and looking for insider expansion during those exact cyclical downturns. Well, in Q1, Aristotle Capital Boston swooped in and purchased over 745,000 shares of PWP. We're talking about an estimated $14.6 million bet. That is massive institutional confidence. On top of that, PWP isn't retreating. They're aggressively hiring new partners, and they just acquired Gleacher Shacklock to expand their footprint into the UK market. To Peter Lynch, seeing a firm expand and attract big institutional money at the bottom of a cycle is a massive green flag. He would definitively rate this as a cyclical buy. Okay, time to completely switch gears in Section 4. Let's get ruthless and apply the Benjamin Graham lens. Graham's defensive checklist demands absolute mathematical safety. So walking through his famous intrinsic value formula, we calculate fair value by taking the square root of 22.5, multiplying that by earnings per share, and then multiplying by book value per share. With a trailing 12-month net income of just $19.6 million, the EPS driving this equation right now is incredibly weak.
We do need to explicitly state our assumptions here. Because our source data doesn't give us an exact book value per share for PWP, we're relying on industry comparables to keep our math grounded. But honestly, even if we give them the absolute benefit of the doubt on their book value, the weak earnings side of Graham's equation completely torpedoes this stock's valuation.
And here is exactly why. PWP is currently trading at a sky-high price-to-earnings ratio of 57.4. Benjamin Graham looks for moderate PE ratios, usually well under 15. At 57.4 times earnings, Graham would immediately reject this stock. It offers literally zero margin of safety at these current valuations. To Graham, you are just paying way too massive of a premium for earnings that simply do not exist today. Let's bring in the heavy quantitative math for Section 5, looking at DCF and alternative valuation models. The base case discounted cash flow model from Simply Wallstit is brutally unforgiving. By forecasting out their recently compressed free cash flows and discounting them back to today, the model spits out a future cash flow fair value of just $2.24. Compare that to the $16 to $18 it's actually trading at today, and the quantitative math paints the stock as extremely expensive. And it isn't just the DCF model saying this. If we look at a comparable company analysis, the story is exactly the same. PWP's PE of 57.4 is significantly higher than the overall capital markets industry average of 40.5. And it gets worse. Their direct peers are sitting at an average PE of just 2.7. Comparing these multiples shows us the market is handing PWP a massive premium, well above its sector and closest competitors. All right, Section 6. It's time to pull all these distinct frameworks together for our final synthesis and recommendation. When we blend all these insights, we are looking at a massive tug of war. The qualitative factors, that elite moat, the zero debt balance sheet, and Lynch's cyclical backlog indicators, they all absolutely scream optimism. But the quantitative math, Graham's strict value tests, that 57x PE, and the $2 DCF output, they scream severe overvaluation. So, balancing all of this out, our final verdict for PWP is a hold. You've got exceptional, debt-free brand equity that is clearly sitting at the bottom of a revenue cycle, which is great. But the reality is, you're being asked to pay a massive premium right now. Now, if we see a market correction that brings the share price down closer to the single digits, that would finally satisfy Buffett and Graham's margin of safety, and that would trigger a strong buy. But right now, at $16, it's basically priced for perfection during a really imperfect time. Ultimately, it all comes down to this provocation. Are you willing to trust the incoming cyclical rebound and that smart institutional money enough to ignore the totally terrifying DCF math staring you in the face today? It is a classic battle of qualitative brand power versus quantitative reality. Thanks for joining me on this explainer, and definitely keep your eyes on those M&A backlog numbers.